Good morning, viewers. Welcome to the first half of this year where we present our SA listed property dashboard. I am Binette Gasson, COO at Catalyst Fund Managers, and this morning I am joined by two gentlemen. I'd like to introduce you firstly to Andrew Brooking, founder of Java Capital, a company that specializes in corporate finance deals, and then a very familiar face, Mr. Mvula Soroto, Director and Portfolio Manager of our SA listed property capabilities. Mvula, I'd like to kick off with you. As at the end of June, we know if we look at the last 12 months, SA listed property did very well, roughly just shy of 26%, and outperforming all the other SA asset classes, which includes equities, bonds, and cash. However, we know year to date it's been lagging equities and bonds. Can you maybe unpack that a little bit for us today?
Sure, thanks, B. Look, I think it's important to contextualize the returns. I think SA property has come off the lows of 2020 and has had a great 5 and 3 year return year to date. Looking at the last 12 months, like you mentioned, 2024 was an absolutely fantastic year for listed property. But year to date, we have lagged other asset classes. I think a large contributor to the lag has been the outperformance since 24, but the first quarter of 25, we saw a lot of uncertainty, firstly on the global front, where there's been increased tension regarding trade and global tariffs. And looking at the local front, we saw obviously on the political sphere, including the fiscus as well, there were a lot of uncertainties related to the budget. There were proposals of VAT increases and including instability in the GNU. Subsequent to that in Q2, we saw SA listed property rebound strongly on the back of the passing of the budget, the scrapping of the VAT hikes, and then the interest rate cuts that we saw from the SARB. I think that led to an increased investor sentiment and improvement in capital markets. Over and above that, I think it's important to talk to specifics regarding listed property. The companies that have reported year to date have actually reported strong operating fundamentals. They have revised their earnings upwards and in fact have beaten our own and consensus forecasts. Looking at individual names, I think a thematic that's played out has been the offshore names. The UK listed property companies have outperformed SA counters, and a lot of them has been on the back of corporate action that's played out, the likes of your Shaftesbury Capital and Assura and PHP.
I want to focus on that specific section, Mvula. Andrew, and I'm going to pose this one to you. We've seen a lot of corporate action over the last few years. I think all the market participants are very well aware of Fortress's A and B share structure. So we've seen that disappear. And then there's obviously the deal between Fairvest and Arrowhead. I'd love you to unpack those, share your views with us. If you want to touch on a few more, okay, please go ahead.
Yeah, so as I think I've said, to get a merger or an acquisition done at a corporate level is difficult for lots of reasons. But the Fairvest Arrowhead merger was unusual because Fairvest managed to acquire, through a share swap set of transactions, it managed to actually lock down an acquisition of just over 50% of the issued shares of Arrowhead before it picked up the phone to Arrowhead and said, how about a merger? And the conversation is very different when you pick up the phone and say, we'd like to merge with you, and if you don't want to merge with us, we'll be your 50% plus something shareholder. That's a very different conversation to picking up the phone and saying, we don't own anything of you, but we would like to merge. When you've got management teams and boards with their own empires, getting them to agree to a merger without some risk taken by one of the sides in order to bed down a position, it's difficult. So Fairvest Arrowhead was an interesting proposition, and they got the merge done, and they managed then to start cleaning up, to divest of so-called non-core aspects of the greater merged pot. And it was great for Fairvest because it moved from being a very small cap but well-regarded entity. We always used to say, Fairvest is not yet in no man's land. But it bought merged with, effectively buying a bigger business, started cleaning up, and it's achieved a good rating since then. So that's interesting. The Fortress capital structure took a long time. So the twists and turns, there's a reality to cleaning up by way of a restructure or a capital structure redo, reset. Sometimes you have to wait for the right time, because Fortress proposed it a few times. It got knocked back a few times. Ultimately, when it was approved and implemented, it's been very good for Fortress. Very good for the rating, cleaning it up, taking complexity and noise out of it. So cleaning up is undoubtedly been a good theme that underpins and supports corporate activity.
Willa, maybe your view on the Fortress deal. I know we were quite heavily invested on the A side, but just maybe your views on how it all played out.
Yeah, look, we think corporate action was needed in the sector, given where a lot of listed companies were trading during COVID, 2020-21, steep discounts to NAVs. But particularly on the Fortress deal, I mean, we thought the capital structure was suboptimal and quite restrictive. Like you said, we own the A shares, which actually had preferential rights, relative to the B, which we viewed as high risk. And given that, there were challenges in management actually deploying capital, hence the restrictive nature of the capital structure. Since the single share class, we think it actually has helped management to allocate capital. We have recently seen them actually divesting out of NEPI, actually improving the capital structure balance sheet to actually redeploy into the South African operations, which are obviously yield accretive, given the land and the development pipeline that they've had. And again, it's improved the earnings visibility for a single share class. Part of the reason of that transaction was that the embedded portfolio was traded at a steep discount, let's call it to net realizable value. The core logistics or SA portfolio that Fortress owned was steeply discounted by the market given the uncertainty on the capital structure. Hence, the corporate activity was needed. I mean, if you look now at the Fairvest Arrowhead proposition and transaction, I mean, again, there we were shareholders of both businesses, and we were quite supportive of the transaction. Again, we noticed operational inefficiencies in Arrowhead at the time. Fairvest, obviously a specialist retail, identifies a portfolio that was quite diversified, but like as Andreas alluded to, had a retail bias. And given that unwind and divestiture out of non-core, call it office portfolio, the portfolio now is actually heavily weighted towards retail. And given the strong management team that we backed, they've been quite proactive, obviously, in managing that portfolio. The counter has actually re-rated materially and created significant shareholder value. As we speak today, the company is actually traded at a premium to net asset value, talking to that value that they've created over time.
Gentlemen, I'd like to probably just want to take a step back and ask you the big why. We see a lot of this activity, but why is it? Is it about scale? Is it about liquidity? Is it about valuation mismatches? In both of your opinions, why would you say we are seeing quite a lot of it?
There are always two contrasting themes when you evaluate the investment case of a REIT. The one theme is bigger, better. A bigger market cap results in more share liquidity, a deeper secondary market, and investors want liquidity. They want to be able to get in and out. But the second theme sometimes runs counter to size, and that's specialization. So focus does drive better performance, and there's a lot of data in a lot of markets that supports that. So if you want the best performing REIT, you're probably going to go for something that's narrowly specialized. The price of the specialization is that in a smaller market like South Africa is, you may not be able to get to scale and liquidity if you are too specialized, which may then require that you pursue that specialization in another geographic market, which can be fine, but it doesn't always work well because we've got a certain cost of equity driven by our macros, and sometimes that cost of equity doesn't allow you to grow a business efficiently in another market where the returns are not sufficient given the cost of equity. And then you get into a whole lot of complexities about multi-currency businesses, How do you manage currency risks? Do you use derivatives to... I mean, what we saw in the SA sector for quite some time was companies using diversification as part of a rationale to raise South African equity, taking the raised equity, buying assets in other markets, and then essentially swapping out a lot of those economics, which then undermined the diversification but gave you a better real yield on a rand basis. So some of that, it's a little bit more technical than you need, but the impact of those cross-currency swaps was sometimes to boost yield while creating balance sheet risk. But it was also undermining of the diversification that was one of the themes that accessed the capital. So these are all, and then the other point, which I'd love to hear Mvula talk about, is the role of innovation in a listed property sector, because we have had quite an innovative, adventurous property sector. Some people use that as a criticism, and others say, well, we've got a big, pretty dynamic REIT sector relative to the overall size of the economy and the overall size of our stock exchange. So as a sector, it's done well. And there was a lot of innovation and a lot of willingness to incubate possible ways to create value. So I would say, for example, that if you look at capital structures, you look at Fortress, that A and B structure, you know, I was there in the old days when Apex High was the first one with an A-B structure. And we sat with Gerald Leisner and he said, okay, we've got A and B shares, but why don't we have A, B, and C shares? Because if we cut the cash flows up into multiple securities and we then add up the market value of all of those securities, have we created additional market cap and additional value? And actually, it did work out that way. So it's a corporate finance exercise that changes nothing. But when you put different risk-reward propositions to different categories within the capital structure, sometimes you appeal to different investors. So an A share, which is really a kind of a perpetual preference share, you could buy that and be relatively agnostic about real estate and be relatively agnostic about the company in question, provided the cash cover on your dividend entitlement was deep enough. So it was useful at a time. I'm not saying it didn't stand the test of time.
No, and again, I would agree with you and start off by saying innovation is fantastic and it's great, it's needed, right? But not everyone needs innovation.
Yeah.
I mean, if you look at property, the underlying fundamentals of property as an asset class is that you've got real assets underpinning, constant stream of cash flows, and how that gets distributed is essentially what you're talking to now. And where does the risk sit? I mean, again, I'll go back to the Fortress example where we were owners of the A, preferential rights, low risk versus B unit holders, high risk standing behind the A. Yeah. Ultimately, we think the market generally misprices the risk attached to these innovative instruments. And with that comes, call it the uncertainty of pricing value, i.e. the company or the assets within Fortress, the valuation doesn't change because of the different innovative instruments that are actually underpinning that. And I think we'll get to MES currently that's playing out with the preferential rights or pref shares that are currently embedded in that business. Again, there's risks there that are attached to that business model because of innovation, right? Complexity and the like. But ultimately, what's behind those instruments is real assets. And for us, we think property should continue to be simplified. To your point, the environments that are actually conducive for certain instruments, a high growth environment was conducive for the B, a low growth environment obviously was supportive of the A, given the preferential right and the cumulative growth in the distribution. So we think it is needed. To your point, sometimes there's a long tail, the environment is conducive for certain innovative instruments. So you could incorporate it, but I think to your point, ultimately the value doesn't change given the innovation that plays out. Yeah, I'll leave it there.
Can I ask you one other thing about innovation? Because we touched on specialization, sure. So I think we all acknowledge specialization drives returns.
Sure.
And specialization doesn't have to be a particular asset class. It could be specialization within, say, a precinct or...
Correct.
So specialization is a wider term than just office versus retail versus industrial. But what we have seen in the deeper markets, particularly in the US, is we've seen outperformance from REITs based on digital assets.
Yeah.
Data centers and other forms of digital assets, fiber,
Sure.
technology, infrastructure. These have been top performing, and we've seen some of the big US REITs, for example, kind of retread and reinvent themselves, sell off their real estate and end up owning digital assets.
Sure.
So, I mean, we've been quite active in that space. We're pretty bullish on it. We think the economics are attractive. I mean, how do you see? But it does require innovation. So if the investors are saying, give us bricks and mortar and give us a certain return with a CPI-linked escalation,
Yeah.
then I think that sometimes is not expansive enough to allow for the kind of innovation that would see, for example, a switch to the better returns out of digital assets.
Yeah, look, I mean, again, you raise a relevant point there. I think there are key things to differentiate there. I mean, real estate continues to be real estate. We can't change its nature and its characteristics. I think some of the elements you're talking to is part real estate, part infrastructure, i.e. towers, for instance. Currently, we don't have exposure to that in the South African landscape, but our global funds tend to have exposure to that. You talked about digital assets as well. Data centers we've got exposure to on the global front. Unfortunately, given South Africa, given the size of our country, I think we'll get there. Innovation is still playing out. We've seen some US names come and actually buy some of our tower assets, but it's a handful of assets. And again, like to your point earlier on, you need scale within the businesses that we operate in. I mean, if you subscale, you tend to be illiquid and there's no liquidity. So I think given where we are, it's still early days for the South African market to actually embrace that technology. But I think with time, definitely there will be scope for those type of innovative products.
Willa, when we speak to clients, they've often asked us in report backs, are the stellar returns from 2023 and 2024, are they going to repeat themselves? And often we have to share with our clients that that's not quite the new normal. So in your view, and obviously you and your team do a lot of work on this, what is your outlook for the SA listed property sector looking forward? And also, how is your portfolio constructed from a positioning point of view, from a geo and sectoral point of view?
Sure. Look, I think maybe to contextualize future returns, you just need to look at what's happened in the past. I think the last 3 to 5 years has delivered stellar returns on the back of, call it steeply discounted price multiples. A lot of listed property companies were trading at discounts to net asset values. And the primary reason for that is because the market perceived there was a lot of risk attached to investing in property. We come from COVID where there was elevated risk, uncertainty around earnings. In fact, there were dividends that were postponed during that period and lack of clarity, risks around balance sheet and the like. I mean, since then, I would argue that risk has diminished materially. A lot of companies have improved on their balance sheet capital structures. A lot of companies have started paying dividends, and I would argue sustainable payout ratios now have been introduced to the sector. ESG or governance concerns surrounding the sector has been improved on, and we continue to improve on enhancing that. And more importantly, we think there is earnings visibility. So as it stands today and the outlook going forward, we see the sector trading at around 8.5% to 9% earnings yield. And we think that yield or the earnings will continue to grow by between 4% to 6% over the next 3 years. That in itself would mean that total returns for the sector would be anything between 13% to 15%. And of course, we think there will be continued corporate action to realize the embedded value that a lot of SA names are trading at relative to NAV. So there are opportunities there for further re-rating. Over and above that, the sub continues to cut rates, and should there be further interest rate cuts, we think a yield compression will play out, and again, supporting valuations for the SA listed property sector. When you talk to our fund positioning, look, we like specialists. We are overweight retail specialists, both SA and offshore. In SA, we like the names like iProp, conservative balance sheet. They recently raised capital and recently disposed of the Hyde Park Corner asset, which again has positioned them well and on the offensive, I think, for years to come. Our earnings visibility on that, we've seen double-digit earnings growth into financial year 26 and an attractive yield. I mean, Hyprop is traded at a discount to net asset value as we speak. When you look at NEPI, again, underperformed its peers and SA names year to date. We think it's a core holding with euro earnings that is quite stable and attractive at around 9.5 yields. And again, NEPI also trades at discounts to net asset value. So we like specialists. We are underweight, diversified, heavily geared funds, the likes of your Growth Points and Redefines. I mean, of course, office subsector continues to recover, but we think long-term will continue to underperform other subsectors. And we spoke about innovation and, well, let's call it complex instruments that have been introduced. We think the likes of your Growth Point and Redefine still need to sort out that complexity around the offshore investments. Obviously, are still using cross-currency interest rate swaps for those investments that are, I'd argue, subscale now, illiquid, and we'd like to see them actually bringing some of that capital back to SA before we start positioning back into those businesses.
Gentlemen, thank you for taking time out of your busy schedules to be with me here today. Andrew, thank you for sharing your valuable insights with us. Mvula and Andrew, thank you for the robust conversation. Viewers, thank you so much for tuning in. If you'd like to learn more about the SA listed property market, please refer to our full H1 SA dashboard, or alternatively, please reach out to me as per the contact details below. Thank you and goodbye.